You are listening to Mining Stock Education.
There might be a reason why, it's still consistently trading low. So when you look at something that's cheap, you really got to ask yourself, why is it that cheap? So don't be afraid of buying something that you think sometimes is full value, because sometimes those are the ones where everybody's putting their money into. And liquidity does matter, especially if you're not willing to do a lot of work.
Thanks for tuning in to Mining Stock Education. I'm your host, Bill Power, speaking today with Joe Mazumdar, the expert over at ExplorationInsights.com. Joe, thanks for coming back on the show. Now, you've done a lot of things in your past. You've worked on the finance side of the business. You were a geologist. You worked for the majors. So my first question will be regarding two big companies that are talking about potentially merging. It would be a mega merger between Rio Tinto and Glencore. There's rumblings of this. What's your commentary that you can provide here, please?
Oh, yeah. We had Anglo-American and Teck. That merger is pending and almost approved. One of the big obstacles was Canada, but I think probably that has spurred a conversation that's been happening for a few years between Glencore and Rio Tinto. That probably failed a few times in terms of who would be the new CEO and what you would do with the merged assets. But I think it's gained more momentum potentially because of what's happening in the critical mineral market, fragmentation of markets, and there's much more enthusiasm for mergers. But importantly, it's still hard to permit, and it's hard to get feed different markets. And so to have a bigger global outreach, and to be able to use more assets that are already permitted, and jurisdictionally where you want to be. Now you could pick the plums out of both portfolios and go forward. So I think it makes a lot of sense for the two. And then if you look at the trading, the market believes it makes a lot of sense. Both of them are trading near 52-week highs going forward. But I would also add that, scheme of arrangement, merger of equals, I'm not sure how it's going to work. Rio's twice as big as Glencore, so I would assume that Rio management would take it going forward as they're more operators. But also these guys get much more processing facilities. From what I know, that they'll have aluminum, iron ore is big with Rio, but copper is big with both of them. And I think that's one of the growth items right there. And then also the smelting and refining capacity that the joint companies bring, because Glencore has a lot of that in Canada as well. And they also, Glencore, have growth projects in Argentina with El Pachon and Agua Rica that they're running through the RIGI process in Argentina right now to get the tax breaks and the new federal incentives. So yeah, I think it makes a lot of sense. And this is probably the time to do it. And if we look at investing, we think, they're much too big. How much bigger, or how's the share price going to grow? Because they're going to be like, I think about $200+ billion. The thing is that the people that made their money off of AI, the tech sector, this is still a fraction of those companies, and those were $1 trillion companies, and now we're talking about $200 billion. So with that sort of mindset, they'll attract those kind of investors. So I think that's the way forward for a lot of these companies.
And what do you think it says about the market cycle that they're talking about a mega merger here? Is there any indicators of where we are in the cycle in that regards?
Yeah. Usually M&A indicates that prices are going to go up. I think what they're thinking is not only will prices go up, but different parts of the world pricing will be different, potentially, because now the U.S. is talking about putting price floors on some critical minerals to assure that domestic production continues. So it's not only about, how much copper can I produce, but where am I going to produce it? Who's it going to go to? And can I smelt it there? Do I have to send it to China? So there's a strategic advantage for having more smelter capacity, let's say in North America or in the Western Hemisphere, including Europe. and then avoiding sending your concentrates to Asia and having more cathode production locally, and that strategic advantage, is probably something else that they're thinking about, and that also drives the new technologies to leach sulfides, so you don't need a smelter. I mean, that a lot of that's not commercial on a scale that would take smelters out, but for specific projects, the pilot plants have gotten bigger, and so they continue to test that as well.
I know some mining investor friends that don't ever think in our lifetime another smelter will be built in North America. Would you agree with that, or could you see another smelter, a new smelter, being built?
A new one? Well,
because of the environmental pushback and the not in my backyardism.
Yeah. The Hayden smelter, I think it was Hayden. That was a Sarco. There was another smelter that BHP owned, and I'm not sure if it was Hayden, but it's in Arizona, and that was San Manuel. Sorry, San Manuel. So when I started with Phelps Dodge as a market analyst and a trader in 2003, the copper price was about 55 cents. That smelter was being dismantled by BHP, and the Chinese had bought it and taken it over to China when they were growing their smelter capacity. Now 50% of the smelting capacity for copper is in China. But now people are talking about, there's rumblings about trying to put those kind of smelters back into place where they've been before, that everybody knows the environmental impact. And also now, with the new technology, the environmental impact is probably a lot less than it was back when they produced there before. So I can see smelters that used to be functional in specific areas being restarted. It won't be immediate. It'll take a little bit of time. Technically, the Chinese are way ahead of the West in terms of now smelter technology versus what we do, and they're the experts, not the Western companies. But I think that could happen. That could very well happen. But before, I think ESG was a bigger issue under this current administration. Federal permits for a lot of that won't be as hard, as long as you can get it into this window.
Okay. So we're seeing capital expenditure from Kinross with some of their gold projects in Nevada and Washington. And then Codelco is expanding over a $2 billion capital expenditure to increase their copper capacity. What does this speak of in the market?
Well, I think one big thing it speaks of is you're expanding capacity at permitted mine sites. And so what that helps you with is it pushes back the liability. You don't have to close it. Takes advantage of increasing in prices and timeline because it's already a functioning operation. You don't have to worry about capital escalation. You don't have to worry about development timeline. You don't have to worry about major permits. You're probably just expanding the tailings facility, modifying a permit here and there, which under this administration would be pretty quick. So that makes a lot of sense for Kinross. And in this environment, expanding in North America makes a lot of sense in terms of permitting. Like you said, 2 in Nevada, Bald Mountain and Round Mountain, and one in Kettle River. The Washington one has been around for a while. And it has a lot of implications for, operations that might want to look at toll milling in British Columbia as well. So that's definitely an interesting one. With respect to Codelco, a bit of a difference. Codelco is almost running to stand still. They have aging mines. They have aging infrastructure. Chile is the biggest producer of copper in the world. They produced about 5.4 million tons of copper. That was in 2025. 25% of that comes from Codelco. But what's interesting about this from my perspective is we'd always talked about the problem with copper, and the reason the copper price has got to go up is because nobody's going to build under the current copper price. Why? And this is talking 6 months to a year ago, because the capex intensity is so high. So there was a study by the S&P Global Market Intelligence, like you were saying, that it's the Ministro Hales deposit, which is a mine. They need $2.8 billion just to expand and produce 30,000 tons more. So that is like $93,000 dollars per ton of incremental capacity. That is ridiculous. And then the average is about 20 to 25. One that blew everything away was, Quebrada Blanca 2, which was around in the 50s, 50,000 tons. This one is ridiculously high. So if that's what we need, and this is an expansion, it's not a new project. QB2 is an expansion of an operating mine. Granted, it's a lot different because they're milling it and they need tails and they produce a concentrate as opposed to SXEW. But, these are, operating mines. And so that CapEx intensity is what interested me about the article about Codelco, is that they're doing all this, spending $2.8 billion, but oh my God, that's not getting them a lot of production.
We had Brian Dalton, the CEO of Altius Minerals, on the show recently. And speaking of copper and the incentive price, he says people think it's $6, but it's actually double $6. $12 a pound copper is the true incentive price where you will really be able to see projects being flooded into the market.
Yeah, flooded is probably, you got to watch that word because
he said a lot will be getting sanctioned at that point.
Yeah, but the problem is that the price won't change permitting, right? If you have a social license to operate, it doesn't matter if the copper price is 55 cents or $10. It's not going to happen. And a lot of the copper projects, in British Columbia, Yukon, and that, who's going to give them that capital to build those projects? Because some of these projects are $5 to $7 billion. Where's that money coming from? So that'll always be a constraint, a financial constraint on some of these projects. And so that is M&A, that is other companies coming in and buying it. But in terms of building in capacity, doing expansions of known facilities, yeah, you'll see a lot more of those projects coming in because people will look at those first. The Newton technologies, all these other technologies about leaching stuff that you've already mined, but you consider waste, but is no longer waste. Now you might be able to crush that, leach it, and make some money off of it, whereas before it was below cutoff grade. But now, what is the cutoff grade? And a lot of that will impact operating assets. But then on the development assets, it's all, one by one. If you're building Reko Diq in Pakistan and Balochistan wants to basically, seed from the country of Pakistan, and then you're in there with a mine, does $12 copper make that project more economically viable? I don't know. It does make incremental projects more viable. Definitely marginal projects more viable that are in jurisdictions that make sense. But also the same thing we see with gold, we'll see with copper, we might see more nationalization. We might see creeping nationalism as people look, oh my God, look at how much money these guys are making. And so that's when jurisdictionally you want to be in places that, there's less risk of that.
So, Joe, we saw Donald Trump, not only is the United States government putting a price floor under things like rare earths, but they're also deferring the tariffs specifically on critical minerals right now, obviously speaking to demand and security of supply. What's your commentary in this regard?
Yeah, I think the initial response by the Trump administration earlier in 2025 was to protect domestic industries such that they thought, tariff like copper. At that point, they said, 50% tariff on copper. It blew the ARB out ridiculously. That ARB is usually less than 1%. It blew up to 10 or 20%. I can't remember, but and now it's come back. But the problem is that the industry, the auto manufacturers and other people are construction, everything are probably telling them that, if you introduce these tariffs, that inflation will hit us, and it'll hit us hard, and that'll go to everything. So if you want to build this stuff, it'll cost you a lot more. The mining industry might be, sort of saying, okay, please put in these tariffs. That way we can protect ourselves because we need a higher price because labor is more expensive or energy is more expensive. Power is definitely getting more expensive. But the problem is when you introduce these tariffs to protect an industry, the industry gets uncompetitive. So you need a competitive industry to make sense. I think now the issue is that he's siding more with the end users of critical minerals, whether it's the military or industries saying like, if you don't take the tariffs off, and China's restricting exports, you're restricting us even more, and then raising the price of the only stuff we can get. So now, okay, there's no more tariffs on rare earths, lithium, copper, and other critical minerals, which I think makes absolute sense. But because they realize that the ability for domestic production to replace the imports is not going to happen overnight, especially if they do not have any smelting capacity and no refining. And I've noticed that in a quote from Trump, which was which I thought was very provocative, but explaining exactly what we've all known for a long time, that apparently now the federal government knows that it doesn't matter if you mine it if you can't process it, because it'll still go overseas. That's something we've known for years. But it's nice to see that some governments know that they're, and going back to your question about the smelting capacity, they're going to have to build that up or build up new technologies to leach sulfides because that is where the growth is. But I think in terms of appeasing domestic production, they might talk about price floors, because that's getting talked about in the European Union and Australia and other places, that if they want to protect the domestic industry, as opposed to tariffs on the outside, introduce floors on the inside. So that might be a solution. I don't know.
Yeah, we're seeing the command and control economy from the bottom and the top. Or I guess they're capping interest rates on credit cards at 10%, which is kind of crazy.
Yeah,
I don't know if you saw that. But that's going to have great effects.
That. Yeah, I saw, but and that's the problem with not having a laissez-faire attitude toward the towards the economy, is that just like anything, like in science, medicine, anything, that we do something, but we do not know the long-term impacts for that because we haven't really done it. Nobody's measured it. And so we do things thinking that, oh, this is the benefit, but we don't know what the kick's going to be, because it might take a little bit longer. And how
the net result is, I think, less people are going to get credit to even borrow even $2,000, like in terms of the credit card policy.
Yeah. But I mean, in terms of the tariffs, protecting your industry with tariffs, like I said, I mean, that'll make your industry uncompetitive, because they'll know they'll always have this ability to price themselves higher. The floor hopefully takes into account the higher costs domestically, but also takes into account some of the issues that they have with international production that might be subsidized. I don't know. But okay, if it's coming from this specific country, it's subsidized. Okay, that's we have to know that coming in. If you buy from them, you got to take a little bit of domestic production as well. So I don't know how it's going to work, but we have to realize that this because there is definitely a benefit to having a strategic supply of critical minerals, because we've seen not a geopolitical crisis, but a COVID crisis, and we could see that sort of another sort of crisis that could break up the supply chain. And if you don't have your own domestic supply, and the country in question starts banning exports because they're worried about their own supply, then what do you have? And so, but to incentivize people to build that at current prices, it might not be there, because we're still driven by internal rates of return, by economics, whereas some countries may not be.
Speaking as a U.S. person, our government is catalyzing the mining industry. But as one CEO told me, Bill, the government is our current biggest catalyzer, but it's also our biggest risk. What do you see as the biggest risks in 2026?
Yeah, I would say governments are a big risk. I mean, not only are they coming in and giving us cheap capital, which is on a positive side. So when I say risks, there'll be uncertainty, and it could be a good thing and it could be a bad thing. So in terms of, if we take one, the government, ongoing, consistent, nonstop geopolitical crises, all that, whether good or bad or whatever you think about it, good for the precious metals market, has issues with industrial metals, like who needs what, how is it going to impact economic growth globally, or the two biggest economies, the U.S. and China. What happens there? The other thing is, and then weave into that tariffs, export controls, domestic floors on production. How does all that work? Does that policy make any sense? How do they roll it out? That's another one. I would say, for precious metals specifically, U.S. interest rates, real rates, because we're having this issue with the Fed, one that they want to put this guy in prison, but also, there'll be a new guy coming in. So I don't understand why they're going after this guy, because he's not going to be around long enough to matter. And so what is the new person, and who is the new person, and what is their policy going forward? Because as we know, this administration put in Powell originally, that he is their guy. Does this new guy turn out to be like Powell as well and become truly independent? What does that look like? Permitting. It's been I think we have seen positive moves in permitting in the U.S., but I've seen negative permitting, especially for exploration in British Columbia. The note about creeping nationalism as people see permits, see prices going up, how much, because now governments can read financial statements. They know exactly what these companies are making and how much they're making out of it. So do they want a bigger stake in the project? Do they want more royalties? That will definitely happen. And so a lot of the increase in all-in sustaining costs that you'll see is the increase in royalty payments. That's what's really going up. And specifically in the U.S., energy costs. That's another risk. CapEx intensity, we went over that in the copper industry, but that could pervade to a lot of other projects because a lot of them need similar stuff. Because everything that we're talking about an environment where it's not the super cycle where everybody's building, where you can get a truck with no tires. That's not the case. But what is the case is that if you get funding, let's say from the U.S. government, suddenly you can't buy Chinese goods and services. Chinese goods and services are not only cheaper, but they're also better quality than a lot of the stuff you'll get in the West. And so automatically you'll end up paying 20 to 30% more. So that's another risk on capital, because we haven't seen an explosion of capital projects right now. Will we? If we do, then we'll definitely be at risk of capital escalation. That'll be a risk. And we talked about resource nationalism. We talked about aging infrastructure, aging mines, lower grade that will require bigger plants, more intense use of power, and a lot of places, a lot more water. And that'll be another big issue, and it consistently has been an issue with a lot of places experiencing drought. So, I mean, that's all I got for now, but if you give me another hour, I'll probably get more.
Well, what I want to know is, now that the bull market is producing a lot of junior mining experts, because it's so easy to confuse a bull market with brains, which is something you warned about in the last time we chatted about 3 months ago, where you said it's a stock picker's market. Can you truly produce alpha when everything is trending up? So what do you use to benchmark your portfolio to see how you're doing?
I would say it wasn't a stock picker's market, because you could pick anything and it would go up.
But it's a stock picker's market to get like true alpha, though, right?
You don't need to, like, you might call yourself a stock picker, but you really, because of the result of what you bought, but really, if you bought 10 other companies, they would have given you the same result. And when you talk about benchmarking, you might not have had to done a lot of work, spent time on YouTube watching interviews or watching their presentation, reading their technical report, as opposed to buying the benchmark, a benchmark ETF that might have done as well or better. That's more liquid. You can buy or sell whenever you want, and is not single asset. So you don't have to worry about jurisdictional risk, permitting risk, capital escalation, raising more money, dilution, all that other stuff. So you constantly have to benchmark yourself to that, not just because, oh, hey, I doubled. Okay, great. But the benchmark went up 1.5 times. So people will say, well, now Should I feel bad about that? Because I still doubled. But then I say, well, how much is your time worth? If you stock picking does worse than a benchmark where you wouldn't have to stock pick, just go with the benchmark. Because what you're picking is actually a negative beta. You're doing worse. And then aligning yourself to the proper benchmark. So what I've been doing is also changing some of my benchmarks. So I've noticed that, the silver companies have way outperformed the gold companies and the GDXJ, which I usually use as a benchmark. But the GDXJ is heavily weighted towards gold. But most of my silver guys have done a lot better. And so to measure them better, now I use the SILJ. And then I look at it and goes, well, yeah, they're still doing better, but, a little bit better. And so, the extra work I'm doing is really this amount of, not that amount. It's not like 100% extra from the benchmark. It's more like maybe 50 or, 30%. I don't know. And then on the copper side, because copper is also, doing better, use the COPX, the COPX, as opposed to the XBM base metal one, equity ETF. And so that's more specifically for copper. It's not easy to find everything. Like, I do have a niche one in rare earths. I actually found a rare earth benchmark, but it's got lithium in it as well. So it's hard to find a pure one in some of these niche markets. But if you're going to play this game and you say you're a stock picker, then measure yourself up against the best benchmark you can to see that, okay, did I really pick an alpha, meaning that I did better than the benchmark, which is generating the beta.
And what is your benchmark for an exploration stock? Let's say a gold exploration stock. How do you benchmark that?
Yeah, I can't. So prospect generators, grassroots exploration, because they are not beta stocks. So they are exploration stocks. They're about a drill hole. They're about technical items. It's much different than what we're seeing. Like most of the work I've done on the development plays, which I've done really well, which usually don't do well because there's your theoretical orphan period. But what people are seeing and that's why they're going up, is people are seeing, wow, if I really want exposure to silver or copper, I need the one that's going to come into production. So who is that? And so there's a lot more retail interest now in development, whereas there never has been before. In terms of exploration, most of the companies in our portfolio, which are exploration, it is Exploration Insights, are more about alpha. More deep dives on jurisdiction, more deep dives on the technical aspects of the individual assets, the exploration programs. How much does it cost to drill? That's more of what I'm worried about. So constantly, do they have the money to test these theories that I approve of? And if they're drilling things that I don't approve of, or not getting the results that I think, sort of suggests that it is something that's worth, that could be something significant. And then also you got to have in your head, what do you think it's going to be? Because if it's a small project but near processing facilities, maybe you don't need as big a project. But if you're in the middle of nowhere, you probably need something significant to justify somebody coming in and building it. So that's another thing you have to work out in terms of your investment scheme. But yeah, I treat exploration completely different in terms of there is no benchmark for that. You're just looking for, like hopefully a triple, but that might take, 3 to 5 years, but that'll take a lot more work in terms of, but that's what we do here.
Mm-hmm. That's the heart of your letter. Is the speculation in the smaller stocks.
Yeah. But if we do, and this is what we were talking about originally, like, oh, hey, you don't do multi-billion-dollar stocks, but not problematically, but on a good side, those $100 million stocks are now billion-dollar stocks.
Would you be willing to mention any, or you don't want to do that?
No, I'm not going to mention, but all I'm saying is now the question is, well, do I sell them? But then I say, well, what's the thesis behind it? Well, the thesis is still getting it into production. Am I negative on the silver price or the copper price or the gold price? No, I'm not. Am I negative on their ability to permit it? No. Am I negative on their ability to access the capital? No. So
execution risk, though?
Yeah, there'll always be execution risk, but then I look around, who else is building? I mean, you probably want to take some money off the table, but do you want to decrease your leverage to it? I don't know, because I look around at these other projects and goes, well, I've done all this work on this one project and I know it and I like it. Am I willing to do that same depth on this other one where I don't know management, sell this and then own that? Yeah, that's possible. But, I don't know, because the ones that I own just keep going up. I know that there is a moment, and we'll come to it, which I will tell subscribers about, that, I will probably take some money off the table. But am I, negative on my thesis? No, I'm not negative, but I understand the volatility of markets and the idea of booking some gains.
So when you describe your relationship with a winner like that, what I've noticed in myself is that I can fall in love with something and then I overlook or gloss over some of the red flags that are starting to emerge. Like, how do you protect yourself from doing that?
Well, I sold one. I sold one right before the end of the year because it was exploration, advanced exploration. It was copper and gold, which I wanted, porphyry sort of thing, very good grades. And they were kind of accessing it. But what I noticed was the access was taking longer and longer and longer. Then there were some changes in management. And I said, okay, we're done. And I sold. So there does get to be a point where okay, it looks like they're making progress to the point where you go, they're not making any progress. I'm going to pull the plug. And they might turn the ship around, but there's other things that are happening with management that I don't like. That now this is a management team that I don't know, and they have a completely different strategy that they'll spend less money and drag this thing out over many years, as opposed to the other former management would have drilled more, and tested it, at a bigger level. So, so when the company strategy doesn't align with mine, or, execution risk becomes much higher. Like if I had a project in Argentina and Milei lost his election, and then the new incentive program that he put in place was not renewed, which it has been, I would be much more worried. Because especially with single asset developers, because they still need to borrow, and their ability to borrow is problematic if they can't expatriate or repatriate money. And that's why most banks don't lend to assets in Argentina. But now it looks like they can. And so that'll be an important catalyst for those guys. And jurisdictionally, I mean, Chile's changed. Now they've gone from left to right. And now permitting is going to be easier in Chile than it was before. And so I do have exposure to a company that's advanced exploration in Chile, because I like the way they're heading, I mean, it's not only price dependent, it's also, as we know, geopolitics related in terms of directionally, what's your exposure and how's that going? And the impacts, the Trump administration going into Venezuela, how does that impact neighboring countries? Like that might be good for Guyana, which Venezuela was threatening by invading the Essequibo region. Is that worse for Colombia? Because he's negative on Colombia. Do I want to invest in Colombia if, he's negative on the president of Colombia? I don't know. Do I want to, dip my toe in that? That's something else to figure out. All these are different questions that are beyond the commodity price,
But these all factor into your investment decision. To point out for the listener, especially the new listeners that are new to junior mining stocks, all these nuances, Joe, that you brought up and questions they should be asking, it's a little bit overwhelming. And sometimes in a bull market, you can just be full of bliss. Like, I know what I'm doing. My portfolio's going up, but actually you don't know what you're doing. You're just riding a wave right now.
Yeah. And and that's fine. I mean, if you're happy with your portfolio, you're happy with what you're doing, that's fine. But the problem is, like you said, like, when boats rise, without rising tide and right, all these boats, is the problem is that when you've got holes, you'll come down even if the tide is high, but it might take a little while for you to realize that. Fatal flaws will happen regardless of the commodity prices. They can't get hidden for too long. They'll be able to raise money, and they'll be able to promote, oh, hey, look at my in-situ value, look at how much I'm trading on an EV per ounce basis. But, there's a reason that they still issue warrants in this kind of environment. There might be a reason why, it's still consistently trading low. So when you look at something that's cheap, you really got to ask yourself, why is it that cheap? So don't be afraid of buying something that you think sometimes is full value, because sometimes those are the ones where everybody's putting their money into. And liquidity does matter, especially if you're not willing to do a lot of work. Liquidity is, a direct correlation with or inverse relationship with how much work you want to do. The less work you want to do, the more liquidity you need. As you go down the liquidity, levels, then you got to increase your workload in terms of monitoring this stuff, because then you take a big risk. Because if you don't know the fatal flaw and you find out 20 seconds after everybody else, you're suddenly trapped in this junior mining company that's now trading $20,000 a day.
So you mentioned fatal flaws. There's a mine here in the States, the Hycroft mine, low grade, gold and silver, hundreds of millions of ounces of silver. There's some metallurgical issues, but it's a big promotion. And there's been some high-profile investors that have invested. That's raised the profile of the company again. I was told to avoid this company years ago, just that it'll never go into production. What is your advice or your take on the Hycroft mine?
Yeah, it's been around for a while. It had different cycles. Like it had this one cycle where
with Allied Mining,
that it went to the moon, but at that time, the idea was that this is refractory when it gets to sulfide. It's low sulfidation epithermal. It's not Carlin. But the oxide was leachable. But, there was a certain extent for the oxide. And what they were trying to do, because they thought that it would take 10 years to permit a new autoclave in that basin, where they were in Nevada. And so they tried a different route. And I've seen the probably the lab testing of this new method with Trona, the amount of reagents they required to pre-oxidize the ore without doing an autoclave. And it was ridiculous. The amount of reagents, how it would work. And, at Newmont, when we looked at metallurgical risk, it was very simple. The highest risk was something that nobody did. The lowest risk was something that we did. And in between, somebody else did. But, when you're talking about lab level, that was the highest risk. Because the gold price has gone up so much, I think the last resource they did, they were talking about 14 million ounces of gold. And this is important for your readers or your listeners, is that when they don't say the grade, that's telling you something. They just tell you how many ounces. So 14 million ounces of gold and 457 million ounces of silver. And so when you look at silver and people are looking for silver exposure and they look at a number like that, they go nuts. Wow, that's excellent. And so what's been driving this a lot is probably, how much ounces they have. And this is the whole ounces EV per ounce. Oh, it's cheap. Look at it, and definitely the share price has done. In the 52-week range is like $2 to $35. It's insane. And they have $175 million US in cash and no debt. And they're drilling deeper and drilling out some of these epithermal veins that are sulfide, but higher grade, but that would involve underground. So if they do the sulfide like you would normally do. And that's what they're proposing now. Now they're proposing an autoclave. Now they're proposing potentially a roasting facility, looking at recoveries there where they would produce a concentrate and then send it to an autoclave. And that technically is probably the best way to do this. Permitting wise and all that, I don't know how long that takes. Capital wise, I don't know how much that is. It's probably not going to be cheap. But technically, that's probably the lowest risk for metallurgically how you would attack Highcroft in terms of gain. But it needs this kind of price. I mean, their ounces on terms of resources were done at $1,900 gold and $2,450 silver. What silver price do you use going forward? I talked to somebody yesterday. They're talking more like $30 now. Gold, maybe 2,500, 3,000. I don't know. But they will be higher. Now people putting out new technical reports, they might be emboldened to put out higher prices. And so that's something that we should be watching with the new reserve statements for producers to see, how they are incrementally raising their prices. And the other person to watch is when people get debt, what are the banks using? In terms of how they look at, usually it's a 3-year average, but analysts to give them a return and keep a buy on some of these stocks will have to use spot.
Well, if you're newer to the mining industry and this is your first time listening to Joe, he's given you a lot of food for thought. There were so many nuances you have to consider before you invest in a junior mining stock. If I were you, I would go back and listen to this again just to hear Joe think through some of the investment rationale that goes into his thinking process, because one of the things you might miss in a bull market is that the process you would take to picking stocks is more important than the current results you're getting. That was one of the things I was trying to point out as I was listening to Joe talk. You want to keep those gains, and if you think you're smarter than you are, you're prone to lose them. So that's my friendly advice. Joe, as always, I appreciate chatting with you on the show every 3 months. Your website's explorationinsights.com. Is there anything you want to point out to listeners that they can find there?
Yeah, I mean, we got a lot of free stuff on the website if that's where you are. And if you email me at contact us at explorationinsights.com and are interested in subscribing, we could send you like a sample letter for you to check it out. It's a monthly subscription or annual, cancelable anytime if you want to just take a listen. It's not for everybody, obviously, because we do deep dives into companies and there's a lot of technical ability, capacity that we try to demonstrate. But yeah, for our subscribers who tend to be a little bit more into the market and want to understand the nuances, that's really our audience.
Excellent. Well, thank you for coming on the show today.
All right. Thanks a lot.